Hi, today is Sunday, October 21st, 2018. And we're taking a look at the S&P 500 as we head into October week 4. We're looking at the daily roadmap, and we're looking at the 10-day simple moving average line here, which is really sinking at a fast clip now, and it's on its way to crossing down through the 200-day simple moving average in about 2 more days, unless there is a very strong rally that treats this as an oversold event and fends off and flattens out this 10-day simple moving average line and gets it curving back up so it can make a cross up through the 20 and the 50-day simple moving average, which is the kind of event we're going to need in order to fuel a rally. The algos are going to need to see this average closing price of the last 2 weeks stop falling down through longer time frames. Why would you want to go out into the market and buy something which price could possibly get lower than that of the closing price of the last year, which is what your 200-day simple moving average is going to represent? It's about 40 weeks of trading. So when you remove the holidays and vacation time and all that stuff, it's about a year's worth of trading. Okay. Anyway, let's get back on course here. So our highs keep failing right at the 10-day simple moving average. During the day on Friday, the 10-day simple moving average by the end of the day sunk down to 27.95. By the close, it was at 27.98 when we opened, and our high of day on Friday only reached 28 or 27.97. So it was literally a 1 point fail of the 10-day simple moving average, and we came on down. And then at the end of the day, right in the final moments, we wound up making a close below the 200-day simple moving average. Now, in the last two videos, I showed you that there has not been 2 days in a row closing below the 200-day simple moving average since the big sell-off of 2015 and 2016. And on the 11th, we made a close below it, but on the 12th, we made a close back above it. And we came in on Monday, we made a close below it, but then on Tuesday, we rallied. We had that strong rally, that turnaround Tuesday rally, where we gapped up open on the 200-day simple moving average and ran from there. But then on Wednesday, Fed minutes day, that's why there's a little white arrow above the candle. There's always a little white arrow above the candle when there's either FOMC, Fed minutes, or non-farm payrolls day. I always mark those on the roadmap, and that's what these little white arrows mean. So on Fed minutes day, we came up, we failed the 10-day simple moving average, and we put in a second close above the 200-day. But then on Thursday, we had a sell-off. We came down, made a low, not quite filling this gap to Monday's close, rallied back, closed back above the 200-day, and then on Friday, it looked like maybe we were going to make that fourth day. So we had 1, 2, 3 days in a row closing above it, but in the final minutes, they decided to close us back below that stupid 200-day simple moving average again. So here we start again, and on Monday, if we close below it, there's two things you can look at it here. Either if it's just a minor little close below it, maybe the plan is going to be to gap us up open and have another turnaround Tuesday and have a run at this 10-day simple moving average again. Or maybe we're going to have the start of what it actually is showing us, the start of a liquidation event, more like what we saw over here with the 50-day, where we were sort of messing around back and forth, never closing below the 50-day. So to get it over and done with, they just came in and they gapped us down below the 50-day for an open here, and we had this tremendous sell-off. And so I highly suggest that if we close below the 200-day again on Monday, that we really have something serious to look at for Tuesday. On Wednesday this week, before the open, we have Boeing earnings, and then Thursday after the bell, we have Google and Amazon. So it is quite possible that we're going to have some stupid little, like grinding thing where we're moving between the 200-day and the 10-day, and that on Wednesday morning, we're going to get that gap up and run if Boeing earnings are good, and drag this out a little bit longer, maybe get up here and fill some of these gaps and so forth to end the year a little, with our little end of year rally. And then not until we get into 2019 do we get the real serious selling. So that's, that's highly possible what we're going to be looking at. But you have some very key things that you can use. You use your 200-day down below it, and you use your 10-day up above it. And our 10-day is sinking fast. It was sunk all the way down to 27.95 by the close on Friday, and by tomorrow's open, it's only going to be here at about 27.85. I think it seems to be falling between, anywhere from 8 to 15 points a day, depending on which candles it's picking up right now. And right now, it closed at 27.95. So if it opens down maybe like 10 points, it's going to be right here in line with our 200 period SMA line on the 5-minute chart, along with our downtrend from last week's high. This is where our 10-day simple moving average is going to be on us at the open tomorrow, perhaps, around this 27.84, 85 level. So if we can open strong and take that out early, that's going to be a good sign. If we open weak, if we gap down open below the 200-day simple moving average, then there's really no use in looking to buy a dip. You should probably be looking to buy some puts and go for the ride on lower. And as far as going on lower is concerned, let's take a look at the gap map here. Okay, I've left these purple bars on here. These are gaps that we've filled already. They're marked with this little gray language here, filled, filled, filled. Here is a nice brand new gap that we put in last week down below us that has yet to be filled. And then here is a gap up above us that we put in last week that has yet to be filled as well. So we have 27.50 down below us. We have 28.0921 right up above us. And if we get above this gap here, we have the 100-day simple moving average and halfway back of the whole move from 29.41 down to 27.10. That's right here at the 28.25 level, in line with the 100-day simple moving average, in line with this broken sort of, uptrend that was holding us, and building support on over the summer. So, that's why I keep calling out, that if we could just get above the 10-day simple moving average with some strength, that we're probably going straight up here to 28.25. We probably have a good rally that we can look at to 28.25. So, if you're not into buying those $5 calls and puts that I like to buy, if you want to do something that's a little further out of the money, I would suggest you keep as close as you can to this 28.25 level, because it's, very possible that that's as high as we can get before falling back. But if we do break out above this, then, you'll have a good winner. But either way, you can make some money. If we're down here and you're buying calls that are going to require getting through a 10-day, a 100-day, the halfway back of this move, plus this trend line, plus getting through the 20-day and the 50-day, and you're buying stuff up here in the 2900s that only has like a week to expiration, that's just kind of like, why don't you just buy those Mega Million lottery tickets instead? So that's kind of, what my comments about, why bother even trading the S&P 500 right now? Just buy some lottery tickets, because people tend to want to spend just $2 on something, and you have to get through an awful lot in as far as resistance goes to get up there. So focus on this 28.25 level right here, and let's see if we can do it. If we are going to go to the downside, on the other hand, we still have one gap from this year that we did not fill in our sell-off. And we have a trend line here that is coming in at around 26.46 to 47 and rising. And I want to show you where that trend line comes from. That trend line originates from right here, this September gap where we gapped up open, and it led us all the way to the January 2018 high from which we sold off from. And I think a lot of sellers were expecting that this gap was going to fill here on down at 24.61. But instead, what was bought instead was this little break here, intraday break of the 200-day simple moving average. So that's the power of that 200-day simple moving average. And you can see here was our one and only close before this new set that we just started up in October. Here was our one and only day that we closed below the 200-day simple moving average. And that was the back test of this low. And that is the third point that supports this uptrend that comes from the base of this gap. So when we roll back here, logic would dictate maybe that if we break the 200-day and we work our way down once again out of this channel and we work our way past this original breakout line, and we, don't stop at just a back test and bounce off of that, and we work our way on down here to the rising, this rising trend line and break that, logic would dictate that maybe we are on our way to filling this gap down here at 24.61. Right in between this trend line and this gap is our 13% off level, 13% off the all-time high. This would be our overshoot of 10%. Maybe once again, sellers are going to be left in the dust without getting this gap filled, and we're going to bounce and make a third higher low in a row here for 2018, holding at around 13% off and never filling this gap and frustrating the hell out of sellers. Or we're going to just bust on through here and go ahead and fill that gap. And filling that gap would take us down to 16.3% off of the all-time high for a nice little overshoot of a 15% off move, a 15% correction. Okay, so even if we don't do this now, before the end of the year, if we bounce back up here and we never take out the all-time high, you have to know where these things are and these possibilities. Because until we make a new all-time high, this X amount percent off of that all-time high is still out there and is still a viable chance that we get it. And until we make another new all-time high and hold support for a while, we are still vulnerable to coming down here and breaking down and perhaps filling this gap. So some things to keep in mind for the future. And my one final thing that I want to talk about before ending this video is that we're having an event happen on the VIX ETF, the VXX. I got this off of Twitter. Somebody pointed this out, and it really perked up my ears because it's totally my style of thing to look out for. I'm not a big watcher of the VIX. I use it as an intraday indicator on my grid. But what I really thought was interesting here was that somebody pointed this out, that the 200-day has finally started to click up on the VIX. We have not seen a rising 200-day line. Here's the pink line is the 200-day line. We roll back, and we roll back, and we roll back. And even at the beginning of this year, when was the last time? Well, you guessed it. The last time we saw the 200-day on the VIX flatten out and rise a little was back in that second half of the big two-part sell-off, the 2015 sell-off that continued on for us into 2016. It started in 2015 and it continued in 2016. And remember, we're looking at the VIX here, so we're looking at an inverse chart of the S&P 500. So the 200-day line began to rise. That was the last time. And as you can see, it rose and it flattened out for the longest time, and then it rolled over. And it has continued to fall, and it has not flattened out. Even here, even during the February sell-off of this year, it never ticked up. But here it is. It has flattened and has begun to tick up. And you've got the 50-day simple moving average ticking up, and you've got the 100-day simple moving average ticking up. I really don't look at the 10 and the 20-day on something like the VIX. I don't even place that much in the 50-day. The 100-day, yes, maybe. But the 200-day line, that's really something. That's 1 year on the VIX, and we have not seen it rise since 2016. And here it is, flattening and rising. So that just, to me, adds a little bit more of a compelling argument towards the short side than the long side. But of course, as we have seen many times, sometimes these are treated as oversold events, where it's time to get in there and buy, because if you don't buy now, it's going to start turning into Armageddon. We're going to start seeing integers go down once again in the S&P 500, where we're going down 100, 200 points. And, like I showed you in that last chart, easily we could be going down to the 2,500 handle again. And if that's not good enough, we could be going down finally to that 2,400 handle that a lot of people were really gunning for back here in February with that low. And that's it. I'm going to end the video finally. Good luck and good trading. Enjoy the rest of your Sunday.